All right, let's get started here. We will continue from where we left off last time. Last time we were talking about different return patterns in the historical data that represent the weak form test of market efficiency. Here the idea is, can past or historical information be used to predict future performance, right? And I think we talked about the momentum effect. So again, just to quickly recap, momentum pattern is basically in the historical data, what we observe is that recent past performance continues. Stocks that have done well in recent past, they continue to perform well in near future. Stocks that have performed poorly, they continue to perform poorly in near future as well. The time horizon is important here. Recent past meaning time horizons of up to 1 year, and then we also basically implement this strategy over up to a 1 year period, right? So you can, for example, look at performance over past 6 months, identify the best performing stocks, your winners, and identify the worst performing stocks, your losers. Winners continue to do well, losers continue to perform poorly. So you will take a long position in winners and short position in losers. That would be the momentum strategy. And we also looked at a variation of this momentum strategy that is based on the 52-week high price, right? So that one is basically the idea that stocks that have done well, or the stocks that are trading close to their 52-week high, they tend to have superior performance in future. As we discussed in class, you can think about this ratio of current price to 52-week high price, right? The maximum possible value of this ratio is 1. If the current price of the stock is actually the 52-week high price, then the ratio would be 1. And what we are saying is that we want to buy the stocks that have high value of this ratio, and we want to short the stocks that have low values of this ratio. So basically we are taking long positions in stocks that are trading at or close to their 52-week high prices, right? And historically that strategy seems to have performed quite well, right? And again, when we say superior performance of these strategies, we are referring to uh, risk adjusted performance, meaning that risk using beta or other metrics has been accounted for. Now, this is over horizons of up to 1 year, so relatively short horizons. If you look at longer horizon performance, like let's say you look at performance over past 3 to 5 years, and then identify winners and losers based on that longer horizon performance, what we see in the data is evidence of reversals, meaning that uh, stocks that have done well over this longer horizon, they subsequently perform poorly, and stocks that have not done so well actually start performing well on average, right? So this pattern is the reversal effect. It's not as robust as the momentum effect. All right. So then continuing on, there are some variables that have been shown to predict the performance of the broader stock market. For example, when dividend yield is high, it is shown that the subsequent performance of the overall market is superior. Earnings yield has similar predictability. So again, dividend yield is dividend over stock price, earnings yield is earnings over stock price. And some bond market variables, default risks, and term spreads have been shown to predict future performance. All right. So these are predictors of broad market performance. Momentum and reversals, they are at the individual stock level. This one is for the aggregate market, like if you are looking to predict the performance of S&P 500 and so on. Okay, then talking about some semi-strong form tests. So again, here the idea is, are there any return patterns that are based on exploiting the publicly available information? And there are a few patterns that we are going to talk about. So one is this PE effect, a very popular return pattern, very popular metric, price to earnings ratio. Price is the stock price, and earnings here, the denominator is basically your earnings per share, right? So price per share over earnings per share. It's a very commonly reported metric. Like if you go to say Yahoo Finance, you can actually find the PE ratio for any company that has positive earnings. Like let's use the Microsoft example here. Okay, so here you can see along with other quote information, you have this PE ratio for Microsoft around 23.5. How is that ratio computed? You take this stock price 135.42 divided by earnings per share, right? So this is your earnings per share here, and that ratio would be about 23.5, right? So that's the price to earnings ratio. What is the historical evidence regarding this P ratio? The evidence is that firms or stocks with low P ratios, they tend to have a superior performance. Stocks with high P ratio, they tend to have inferior performance. So low P stocks outperform high PE stocks, and that's the reason why this PE ratio is a popular screening variable. Like a lot of people actually screen for stocks based on different variables, and one of the popular metrics is this PE ratio. So for example, you might put a stipulation like I only want to look for the universe of stocks that have a PE of less than 20, right? So PE you can think of as how much price investors are willing to pay for each dollar of earnings, and the less they are paying right now, the more is the likelihood that the price might go higher in future. That's the basically the interpretation as to why this low PE ratio stocks tend to have superior performance. All right. Then couple of things that we have already talked about in our market efficiency, or in our chapter 7 discussion, Farmer Friends 3-factor model. So two of those factors were the firm size and the book to market, right? So small firms have done better than large firms, and high book to market firms that are our value firms have performed better than growth firms. So here you can actually see this these numbers. These are stocks sorted into 10 portfolios based on their size. So size here is the market value, right? So portfolio 1 here, these are the smallest stocks, and portfolio 10 here, these are your largest stocks. So what do we see here? For the smallest stocks, the returns are much higher, and for the largest stock, they are relatively smaller. And there is sort of a monotonic decline here, right? As we go from small to large, the returns decline, right? So this is your well-known size effect. The return difference here is about 11% per year, right? So these are all annual numbers. So this is about 11% per year. These are all arithmetic averages, right? Book to market, right? So book to market, high book to market firms, these are our value firms. Low book to market firms, these are our growth firms. What's the evidence there? Value has outperformed growth. Again, you can see that pattern here. The return difference between these value firms, the group 10, and growth firms, this group 1, it's about 6% per year, right? Little over 6% per year. So that is the book to market effect. Now, one interesting thing about this size effect is that this effect is concentrated in the month of January, right? So small stocks on average have higher returns than larger stocks, but much of that return difference is actually coming from the month of January. So outside of January, if you look at the other 11 months, February to December, the return difference is not that big. It's predominantly concentrated in the month of January. So then the question is, what is so special about January? Well, one of the popular explanations as to why this January effect works is because of tax reasons. So the tax year in US is uh, the calendar year. Okay, so small stocks do better in January. Why? Because one popular explanation is that towards the end of the year, when people are looking at their sort of gains and losses from their investments, they want to sort of take the losses because losses can be used to offset gains and reduce the tax liability, right? So in December, there is all this selling pressure for this small losing stocks, and then in January there's a rebound, right? So small stocks they rebound in January because they are sold off in December due to tax reasons. Okay, there are other explanations too, but this tax loss selling is a popular explanation for this so-called January effect. Related to the small firm effect is the neglected firm effect. Neglected firms are basically firms that are not covered by analysts, right? So analysts cover a number of different firms, uh, and some of the smaller firms actually do not have any analyst coverage, so they are what we are calling as neglected firms. And because they are neglected, there is some additional risk associated with these firms that is potentially driving their higher returns in future, right? So that's just the risk return trade-off for this neglected firms. Okay, so that is these are all semi-strong form tests, the PE effect and the size and book to market effect. And the another one is this post earnings announcement drift, right? So let's talk about this one, post earnings announcement drift. So when firms announce their earnings, uh, what is the reaction in the stock market, right? So if you follow the earnings, you will see that sometimes the stock prices go up, sometimes they go down. And what drives that reaction? Well, that reaction is driven by what we call as the earnings surprise. Okay, so analysts have some forecasts about how the company is going to perform and what its earnings are going to be like for a given quarter. And then when the actual earnings are reported, they might be higher or lower than the analyst's forecast, right? So let's say, for example, analysts are expecting that a stock would report or a company would report an earnings of $2 per share, right? And the company comes out and says that their earnings for that quarter were actually $2.20 per share, right? So that's 10% higher than the forecast, right? That's a positive surprise. Earnings are better than expected. So then what we would expect is that the stock price would go up in response to this positive news, right? And similarly, if the earnings are worse than expected, we would expect the stock price to go down, right? So if you look at this chart here, right, this is again a sort of an event study. The event here is the earnings announcement, similar to the takeover example that we looked at earlier. So day zero is the day of the earnings announcement. Okay, and based on the magnitude of earnings surprise, so remember, surprise is important here. If the company reports what is expected, then there is no surprise and we don't expect much of a stock price reaction. But if earnings are much better than expected or much worse than expected, then we expect a positive or a negative response in to that positive or negative surprise. So based on the magnitude of surprise, what is done here is that companies are grouped into 10 groups, right? Group 10 is the group of firms that have the best earnings. Their earnings are much better than expected. Group 1 is the group of firms that have worst earnings. Their earnings are much lower than expectations. All right. So what happens here is on the day of the earnings announcement, right? Day zero, for the group 10, these are good performers. Their stock price goes up as expected. So again, we have this abnormal return on the x-axis, right? So this is the return after adjusting for risk. So their return is higher on the day of the announcement. So not surprising. I mean, their earnings were better than expected. So obviously the return goes up. And similarly for group one, the worst performers, the return is negative. Their performance is not up to expectations, right? So that announcement day reaction is not surprising. What is interesting here, of course, is what happens afterwards. For this group 10 firms, the stock price goes up on the day of the announcement, but it doesn't stop there. This upward trend continues for next 3 months. You can see that this is plotted over 90 days after announcement. So the stock price goes up on the day of the announcement, but on average, it just keeps going higher and higher for next 3 months. Similarly, for group one, the stock price goes down on the day of the announcement. Again, that's not surprising, but it keeps drifting down over the next 3 months, right? So that downward slide, that decline doesn't stop on the day of the announcement. It just continues over next 3 months, right? Group 5 and 6, these middle groups, these are the firms where earnings are in line with expectations, right? So there is no surprise there. So as you can imagine, then nothing happens in terms of a stock price, right? Nothing much happens in terms of a stock price reaction. So these extreme groups are more interesting there. So what does this tell us? It tells us that on the day of the announcement itself, all that information in the surprises is not fully absorbed by the market. Markets take some time to digest that information. It is taking up to 3 months for the markets to fully respond to that positive or negative information, right? So this is different from our takeover example, right? So if you go back to our takeover example, takeover is announced, right, on day 0, and then the market's reaction is complete. After that, we basically get this flat pattern, right? Here we are not getting a flat pattern. Here we are getting a drift, right? Upward drift here, downward drift here for group 1. So that means, that is suggesting that investors are underreacting to earnings announcement surprise. They are underreacting to this information. They are not fully reacting to it, and that presents an opportunity to come up with a profitable trading strategy. Uh, Even after the stock price has gone up for this group 10 firms, the evidence suggests that you can still buy them and profit because this price keeps going higher. Similarly, for group 1, even after the announcement on day 0, you can still buy these stocks here or short these stocks here, right? These have negative performance, so you can short these stocks here and they keep drifting down. So you can therefore profit from the decline in price by shorting this group 1 stocks and buying this group 10 stocks. So this particular return pattern is what is referred to as the post earnings announcement drift. There is a drift in prices after the announcement of earnings. The drift is in the same direction of the surprise. If the surprise is positive, the price keeps going higher. If the surprise is negative, the price keeps going lower. So this evidence is inconsistent with market efficiency because that new information in earnings surprise is not fully reflected in the prices right away. Okay, and this is also referred to as earnings momentum. All right, so this is a very strong pattern here, a very well documented pattern. One of the earliest ones, actually, it was first documented in 1968. And then, of course, you can think about bubbles, right? So we have the dot-com bubble and other bubbles. Bubbles have a very interesting history, very long history, but there are all these sorts of bubbles. And people argue that if the markets are efficient, you cannot have bubbles, right? I mean, if you think about the dot-com bubble, the prices of these technology companies were way above their fair values, right? At least with the benefit of hindsight, we can say that the prices were just way too high, and obviously that is inconsistent with market efficiency, right? So bubbles are used as evidence against market efficiency. All right, so these are some of the return patterns that seem to suggest that perhaps markets are inefficient. There are a couple of others that I want to talk about. Actually, there's one other that I want to talk about before proceeding further. So we'll continue with that discussion shortly.